bookkeeping and tax services. In our practice, we've been using QuickBooks Online as our accounting software, and we've been using it for many years now. I decided to create a short video on the fundamentals of QuickBooks Online. This is a 4-part series. So the first part is getting started. Part 2 is how to navigate QuickBooks Online. Part 3 is probably the main event. That's the recording of transactions in QuickBooks Online. And Part 4, which is, for me, very important and my favorite, reporting using QuickBooks Online. Mind you that this video is not getting into the weeds or details of using QuickBooks Online. This is again just fundamentals of using QuickBooks, and I'm just covering those basic concepts about using QuickBooks Online and some of the commonly used functions within QuickBooks Online that you can use or apply in your business. Now, after watching this video and you think that's something I don't want to do or spend my time, I'd rather spend my time generating revenue or establishing a relationship with my customers, then no worries. We are here to take that burden off your shoulder. Again, I'm Christy Fontanilla of FAS Bookkeeping and Tax Services.
Hi, so this is the part 3 of the 4-part series of QuickBooks Online Fundamentals. So just to give you again an overview before we dive into the recording. So part 1 is more just giving you an overview of how to get started in QuickBooks Online. Part 2 is more how to navigate the QuickBooks Online. Now, the part 3 is more like the main event, so to speak. It's like recording the transactions in QuickBooks. So before we do that, I'll just give you a refresher of what we've covered. What's really important is understanding the workflow within QuickBooks Online. So here, if you go to the dashboard, so this is, I may note, this is a sample company that we are using from Intuit. So in QuickBooks, we have like 3 areas that involving the main workflow. So first is the money in, which is really the revenue income side. So we have to add the products or services that we're providing, adding customers, creating estimates or proposal, and then after we have performed the service or provided the product, then we send invoice, and then we receive payment, and then get paid for that, which is what we use to pay our bills, or we can also have funding or loans from third party and use that to pay our bills and also to pay our employees. So that's the money out or the expense side. And then the third one here is the accounting. So how we translate all the transactions that happen under the revenue, all the transactions that happen under the expense cycle, and then those transactions are translated into a meaningful format that we call financial reports, and that's where we run the reports and do trend analysis here. In this side, we also, or in this area, that's where we also make sure that we review the transactions. Normally, this is the part where you would need your bookkeeper or accountant to do the reviewing of transactions, doing all the bank reconciliation, credit card reconciliation, loan reconciliation, and payroll reconciliation to make sure that everything is recorded correctly, and so you can have a meaningful financial reports that you can use in making decision for your business. So that's the like a review of the workflow within QuickBooks. So on the part 3 recording, our focus will be more on the sales and revenue transactions and the expense and purchase transactions. So the sales and revenue will cover recording the sales receipts, creating invoices, of course, recording those payments and deposits that we receive from our customer. The second item here is the expense and purchase transactions, and that's checks if we're creating checks in QuickBooks, expenses, bills, and then the bill payments. The other transaction types are like the bank deposits, the bank transfers. Journal entries are normally created by your bookkeeper or your accountant who have an accounting background. And the other tools here, of course, as I mentioned earlier, these are all like internal control that would make sure that financial transactions are recorded completely and accurately on your books. So that involves all the reconciliation and then also closing the books. But our focus for the recording side will be more on the revenue and expense. So now before we go into the revenue and expense transactions, how we're recording those transactions, one thing that's really very important is making sure that your chart of accounts is set up correctly. So the chart of accounts are really a listing of the different accounts on your balance sheet and profit and loss statements, and very important that that is set up correctly because that would drive how accurately and meaningful your financial reports will be generated. So remember, garbage in, garbage out, right? So it's very important that we understand and we're setting up the chart of accounts correctly. If you're not able to do this, then it's probably a good idea to have someone with a professional bookkeeper or accountant to set up your chart of accounts correctly. But let me just quickly go over what I'm talking about here. So in Intuit or in QuickBooks Online, they already have set up some basic or most common accounts that's being used. So you will see here, starting with the savings, the checking, the accounts receivable, inventory, prepaid expenses. Those are all your current assets, meaning have a useful life of less than a year. And then you have here the fixed assets. Those are the assets that have a useful life of more than 1 year. So that's normally have like a depreciation or write-off over whatever is the useful life of that asset. So we have that here as a fixed assets. And then the liability is all your accounts payable, the credit card payable, other payables that you have. If you have loans payable, then that's also under this liability account. So similar to the asset, it's separated by current and non-current assets. So the current assets are assets that have a useful life of more than a year. Those are the fixed assets or non-current assets. I would suggest that you check out our video on Accounting 101 so you get a better understanding of the chart of accounts as well. So, and then after the liability is the equity. So you would have, say, initial investment of the shareholder or the owner, and then retained earnings are those that the earnings that you kept in the business. Now after that, so that's all your composition of your balance sheet: asset, liabilities, equity. Now we go into the income, and that's where the start of the profit and loss, right? So you have all the income here, you have all the different expenses here, and then so that's how it's set up. So the way you set up or you add new accounts here is you go to new, and then here is the different accounts that we just discussed. So you have accounts receivable, other current asset, bank, fixed asset, other assets. Those are all your asset account. Accounts payable, credit card, other current liabilities, long-term liabilities. Those are all your liabilities. And then of course your equity. So that's all your components of the balance sheet. The income, the cost of goods sold and expenses, that's all on your P&L. And then the other income, other expense are all below the operating profit or operating loss line. So other income would be those income that you earn, but it's not related to your actual trade or actual operation. So it can be like interest income, for example. And then the other expense would be, if you have other expense, would be something that's not related to your day-to-day operation. So let's say you're setting up fixed assets, for example. So you just put that, so you purchase a vehicle, for example. So that would be classified as fixed asset. And then say here you've got fixed asset computers. So it's got a breakdown of the different detail types here. So you just put in the name and then the description and then save and close. Now, if you're adding a new expense, for example, so expense would have different type of expense here. So you just have to choose what particular expense item you're looking at here or you want to use. So for example, bank charges, right? Now, what I wanted to highlight here is the cost of goods sold. So the difference between cost of goods sold and expense is the cost of goods sold are those expense that you incur directly in providing the product or service. So for example, if you're on a plumbing business, so your direct cost will be the materials that you use for providing the service, and then also your contract labor. So that should fall under the cost of goods sold. Now, expenses, what would fall under expense for a plumbing company? Say you have rent expense. You're renting not an office but a warehouse, for example, to store all your materials and supplies. Then that would fall under expense, not cost of goods sold. So remember, the cost of goods sold are those that you can directly identify as the expense that you incur in providing the product or service. Otherwise, it's considered as an expense. So why is it important to differentiate those type of expenses into a cost of goods sold and expenses? Well, because if you just put all those labor costs and materials in the expense, then you don't really know what is your total cost in providing that product or service, like what we call variable cost. And that's really very important because that would help you in your pricing and also determining if you are generating margin after you have provided that service or product, and you have enough margin left to pay for your other expenses, like your other fixed costs like rent and the utilities. So that's very important to separate those direct costs, as we call it, under the cost of goods sold, and other expenses under this expense line item. And then the same thing, put the name here, the description, and then save and close. So now I will just quickly go over the different transactions that is included on the revenue income side. So estimates are non-posting transaction. It's like, if you look at it more as a proposal, so you create an estimate, but it doesn't really create any financial transaction in QuickBooks. It doesn't create an expense, or it doesn't create a reduction on your payables, for example. It doesn't have any impact on the QuickBooks Online. Now, the invoice is the one that will create background entries. So when you create an invoice, that means you're sending an invoice to the customer so they know how much was the cost of that product or service and how much they need to pay you. That will increase your receivable and also will increase your income. And I will just mention here, I'm using interchangeably income, revenue, and sales, right? When I refer to that, it means revenue or sales. Now, the payment side, that's really when the customer pays those invoice. And so you create a payment received in QuickBooks and apply that against the invoice to show on your records that this invoice has been paid by the customer. So that will decrease your receivable, and then it will increase your bank account or undeposited funds. Now, the sales receipt is different from the invoice. So the invoice, you send an invoice and then you don't get paid right away. The sales receipt is more like cash sale. So when you receive a payment, then you create a sales receipt at the time of sale. So it increases your income, and of course it also increases your bank account or undeposited funds. The credit memos are used when the customer returns something or you negotiate a lower price. So that would reduce the accounts receivable and apply it against an existing invoice or future invoice. Refund receipts are those when when a customer returns something or negotiate a lower price again, so you issue a refund receipt there. So these are the most common transactions that you use under the revenue cycle. So if we go on the sales and then invoices, well, so let's go first to the customers. So this is where you set up the different customers you have. If you have a new customer, just click here, new customer, and then put all the information about that customer. And then if we go to creating an invoice, so you just click on create invoice here. So it looks like here it's not set up yet, so it kind of asks you how you want to send the invoices. So you can just select what you want to do here. So most common is send an email straight from QuickBooks, especially if it's just the same amount every month. It makes sense to just set up a recurring invoice and then email that straight from QuickBooks. And these are the different types on how you want to get paid, whether it's check, cash, ACH, or so let's just say check here just for the sake of discussion here. So this is where you put your customer email, of course, very important, the billing address. If you have terms with your customer, then this is where you put that. And of course, if you put here the invoice date and you have the terms, then it will automatically calculate the due date. And then of course the product, services. So that's how you create a new invoice. You can refer to part 1 or part 2 in terms of how to set up the invoice format. But I will no longer cover that here. So now we'll show how to do the receive payment. So for example, we have this customer and we receive a payment for this amount, 274. So we click on that. So we click receive payment, and then you can either click deposit to undeposited funds or directly to checking account. So if you know that that particular check will be deposited to this checking account, you can also just put that as a deposit to checking account and then just match it later on when it appears on your banking transactions. So you're not really accumulating any amount on the undeposited funds. And then payment is 274. So just click save and close here. So now moving on, we will discuss the expense side, the disbursement side. So on the left side here, you will see expenses and then the vendors. So if you have, say, a subcontractor and you want to set them up here, so you click on new vendor and then you put all the information, of course the email and then the mailing address. And then if this is a subcontractor that you want to track payments, so you can issue the 1099 at the end of the year, then you just click on track payments here for 1099. So at the end of the year, when you're ready to issue or mail that 1099 to your subcontractors, then you can just run a report from QuickBooks and it will list all the vendors that you mark as tracking as 1099 vendors. And that will be your basis for identifying how much you paid for each subcontractor for the full year, and use that for preparing your 1099. So now we're on the expenses side of QuickBooks Online. So we're on the expenditure cycle, and now these are the different transactions on the expenditure cycle. So starting with bill, those are the transactions that we enter when we receive a bill from a vendor, but we don't pay them until later on. Expense is a way to enter cash, check, or credit card purchases. If you're creating checks in QuickBooks and then printing checks in QuickBooks, then this is where you will enter those. And when you enter a check, that will reduce your bank balances. The bill payment, that is the transaction used to pay the bills entered. So you create a bill, and then when you're ready to make a payment, then you create the bill payment. And then the vendor credit, that's to record either a refund or return from a vendor. For me, the easiest way to enter transactions is through the banking. If you haven't set up your banking transactions to QuickBooks Online, then check out our video on part 1, which is getting started and how to sync your banking transaction to QuickBooks Online, because that's the easiest way and that eliminates a lot of manual work. So the banking transaction will automatically be uploaded to QuickBooks Online or synced to QuickBooks Online. So you will see all the transactions here. So there are 3 categories here. So for review, meaning those are the transactions that's showing here that needing your review. Once you have reviewed it, you can accept it. And so that's recorded on QuickBooks Online. Categorized, meaning you have already categorized and accepted those transactions. And then excluded, meaning those are transactions synced to QuickBooks, but you've already recorded it somewhere, and so you want to exclude it, so you're not double recording the transactions. Now, another best practice here is if you go to the gear icon and you want to click copy bank details to memo, and then show bank details. So what it does is when you go here, it would copy all the bank information, and it will give some description of that particular expense to on the memo. So let's say here, this is a transaction books by Bessie. So it's showing here as uncategorized income. So that means this is a receipt, right? So just a quick overview of the different columns here. So of course, this is the date, the description, the payee, category or match. So if it doesn't recognize that particular customer from the previous month's transaction, then it will just show uncategorized. But if you had that transaction before, then QuickBooks will remember that transaction and would show that here as well. So let's see. And then the spend is the disbursement, and receive is the money that you receive or you collected. And this is where you take action if you want to add that transaction or accept that transactions. All right, so these are mostly received. Okay, so here you can see here, not the script. Oh, here, let's just do this one. So Hicks Hardware, one match found. So there was a check that was created in QuickBooks. So it's matching to the one that's synced or uploaded to QuickBooks Online from the banking transaction. So what you do is you just match it, and that's already accepted in QuickBooks Online. Now let's say on the credit card here. So these are all the credit card transactions. Let's say, okay, so those are all turned on here. So for example, nursery. Okay, so here is, it's trying to find a match. So that means there was a previous transaction already for this particular account. That's why it's showing those match transaction. But you just have to be careful with this, making sure that what's showing here is really accurate. That's why you don't just match or add it, because you still have to double check if it's correctly showing here as match, or showing the last transaction if that is correctly coded. So now once you have recorded all the transaction, the next step is really to do the reconciliation. So this is something that your bookkeeper or your accountant should be doing on a monthly basis. And this is more like an accounting procedure that must be done on a monthly basis to make sure that all the financial transactions are recorded completely and accurately on the books. So one of the time-saving tips on QuickBooks Online is creating a rule. So for example, on your banking, if there are particular transactions that you have or you use on a regular basis, you can actually use a rule for that. So to create the rule, you just have to go here, rules, and then create new rule, and then just say for shell, that's money out, all bank accounts, and also it captures, or it's gonna be applicable to all your bank accounts and your credit card. And then the description contains shell. And then here the transaction type is expense, and then you would have the category of auto expense, for example. So since it's not yet added there, then we'll just add that particular account as an expense, and then that is under auto. Save and close. And then the payee would be shell, for example. So you set that up as a vendor. And then here is, you have the option automatically confirm transaction this rule applies to. So normally I wouldn't automatically confirm. I still would like to see all the different transactions that was created by rule, and then I still do a quick review, so that makes sure that all the transactions are coded correctly, and then click save here. So that's how you create the rule. So there you have it. We went through the recording of transactions on the revenue cycle. We went through the transactions, recording transactions on the expense cycle, and that pretty much covers the recording of transactions. Again, I would like to refer you to the Accounting 101 video, because that would give you a better understanding of how to record a different transaction in terms of where it's going to fall into, like a balance sheet or a profit and loss. So not all the disbursements are going to be an expense. There's also items that are recorded as an asset, so you have to be careful with that. There's also disbursement that would be more like a withdrawal of an owner's equity, so that the shareholder draw, for example. So that's not going to be recorded as an expense on the P&L. It would show up more as a balance sheet transaction. So just be aware of that. And if you want to get more information, again, refer to the video on Accounting 101.